For this video, let's have a look over at Texas Instruments, who, surprising to most, actually makes a lot more than just calculators. Texas Instruments, by and large, is actually a semiconductor and integrated circuits manufacturer, and creating calculators is more of their side gig, but of course they are mostly known for making those graphic calculators. So Texas Instruments here for the past 10 years has an average growth rate of their revenue of 5.1%, compared to their EBITDA, which has grown by 10%. This means, of course, like I always say, that the profit margins are increasing here. The moment that EBITDA grows faster than revenue, it means that a company is more efficient in operating their business. It means that a company is able to increase their margins, and it means that a company is able to efficiently reduce the cost of operations. So the moment that we have a look here at the profit margins for Texas Instruments for 2022 and then also for the other 10 years, we do notice that they've been steadily increasing their profit margin from 34% in 2013 all the way to 56% here in 2022. Their debt level has been increasing by 6% annually, which is really nothing compared to the EBITDA growth of 10%. Their earnings growth easily outpaces their debt growth, so there's definitely nothing to worry about here. Additionally, we also see them have quite a lot of cash on the balance sheet in their war chest for whatever purpose they deem it necessary. If they want to, they can basically pay back their entire debt load right now if they wanted to. And then we move over to market cap, which has grown by 12.2% annually for the past 10 years. And this is the price that the open market values Texas Instruments at, and is definitely increasing faster than the average trend line of the S&P 500. On average, a market cap grows about 6, 7 or maybe 8%, but Texas Instruments has grown by 12% here for the past 10 years. Definitely a very impressive track record. The moment that we include the debt and we subtract the cash, we get a slightly deviating number, but mostly the same because, like I mentioned, their debt is basically equal to their cash balances at all times. EV/EBITDA, so this is the multiple with which Texas Instruments has been trading for the past 10 years. How many years of current earnings does it take Texas Instruments to pay down the entirety of their enterprise value? On average for the past 10 years, this number has been around 15 times, whereas definitely been moving up and down here for the past 10 years. We see a high of 22 times in 2020, and we see a low of 10.3 times in 2015. The net debt to EBITDA ratio is basically balancing around zero because their cash is always equal to their debt level. So Texas Instruments is completely unleveraged. There is no risk of bankruptcy for this company whatsoever. They make a proper amount of money, a proper amount of jack, so they can definitely afford running their operations for the next few years. And if they want to, they can actually leverage up. So right now they're at 0.1 times. They can actually easily borrow up to 3 times of EBITDA, which means if they wanted to, they can get an additional war chest of, let's say, about $30 billion for any additional acquisition or expansion that they may want to do. I don't think they are willing to do that. I think they're quite happy to go at the pace they're currently going at, but of course if they want to, they got the option available because they have basically no debt to speak of. So let's have a look over at their cash flow here. Cash flow from operations for Texas Instruments has been growing by 10% here for the past 10 years, basically in line with their EBITDA growth. Capital expenditure, however, has been growing a lot faster with 22%. And this is also where we can see for the past 2 years that Texas Instruments has been heavily investing back into their business for any potential future growth. Of all the 8 years prior to 2021, they saw an average capital expenditure of around $700, but for the past 2 years they've been spending well over $2 billion, even $2.8 billion here in 2022. So I do think you can probably expect some additional EBITDA or revenue growth because of the investing that they have been doing into their operations. Also, I think it's fair to say it's not like they can't afford the addition in capital expenditure, because as we can see, their capital expenditure is easily outmatched by their cash flow. The moment that we take their cash flow from operations and we subtract the capital expenditure, we get their free cash flow. And the free cash flow is basically your pro rata ownership of the company. This is all the money that's available to you as an equity owner at the end of the fiscal year. And this number has been steadily growing by 7% here for the past 10 years. And what exactly can they do with this money? Well, of course, they can buy back shares, they can do additional acquisitions or expansions like they have been doing as seen in their capital expenditure. They can also issue a dividend, or they can simply buy back some debt. Basically, there's no debt to speak of, so all this money can be utilized to directly reward you, either with expanding their operations, with buying back shares, or issuing a dividend, which they actually do, of about 2.7%. We also see here that they've been steadily buying back shares for the past 10 years consistently and reducing their overall share count by 2% annually. 1,113 shares in 2013, only 916 million shares in 2022. They basically bought back 200 million shares in the past 10 years and ripped them up in your favor. Very attractive for sure. Free cash flow per share is what we get if we take that free cash flow and divide it by the amount of shares outstanding. 9% increase annually, 2.69 in 2013, $6.47 in 2022. The price on the open market here for Texas Instruments at the start of the decade started in 2013 for only $43.44. This has increased all the way up to $188 here in 2021. The absolute COVID boom, the absolute COVID spike with a lot of stimulus checks going into the stock market, which created a artificial valuation, I think, for many stocks, including Texas Instruments, and the price has been coming down a little bit since then. $167 in 2022, and right now it's actually kind of in between these two numbers of 188 and 167. Their overall free cash flow yield has been 5% for the 10-year average, but for the past 3 years we can see that their yield was a lot lower, more close to 4%. So it seems that the valuation of Texas Instruments has certainly gone up a little bit here for the past few years. So let's try to forecast Texas Instruments here into the future. And we can see for the past 10 years, they've been growing their EBITDA by 10% annually. I think that's quite a lucrative number to give any company double digits, but I definitely think for a semiconductor company, they can definitely reach those milestones. Nevertheless, I want to be a bit more conservative, so I'm going to give them 8% here for the first 5 years, and then 6% for the last 5 years. I'm also going to attach the multiple of 15 times, which is their historic average, so I think it's only a fair and reasonable number here to use. This gives me an enterprise value 10 years from now of $327 billion, from which we then subtract the debt, we add the cash, which is basically the same number. We divide this by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. Historically, we can definitely say that they've been steadily decreasing their share count, but I can't really go ahead and spend their free cash flow for them. They're going to have to do that themselves. So this gives me a stock price 10 years from now of $357.39. And for that free cash flow, I'm going to do a slightly similar thing. It's been growing historically by 7%, and I'm going to grow it by 6% here for the next 5 years and 5% for the last 5 years. I'm also going to attach that 10-year average free cash flow yield of 5%, even though you could make the argument that for the last few years, Texas Instruments has been trading at a lower free cash flow yield, so this actually has to come down a little bit, increasing their stock price. But I want to be a bit more conservative, so I'm going to give them the 5%, because I do actually expect Texas Instruments to probably go back a little bit more towards the 5% average free cash flow yield here. This gives me a stock price 10 years from now of $220.99. Right now on the open market, I can buy as many shares as I want of Texas Instruments for $180. Taking both my projections of the enterprise value as well as the free cash flow model, I get an average share price 10 years from now of $289.19. This gives me a compounding annual growth rate, so an increase in stock price as seen on the stock market alone of about 4.9%. But the moment that we include the free cash flow that we actually projected here in our free cash flow model and add it to our calculations, we get an IRR, an internal rate of return of about 10%, which is in line with the overall market average. On average, I always say the stock market returns about 10% IRR, and I think Texas Instruments would do exactly the same. The moment that we actually reduce their free cash flow yield to 4%, we can see a slightly better return of around 11%, but it's a bit less conservative and I think definitely a bit aggressive of a projection. But if you do believe that Texas Instruments will remain their current yield you can expect an IRR of 11%. So let's see what happens if the price goes up or comes down a little bit. So if the price comes down here to about $130, which is a price range that we haven't seen since 2019, mind you, I expect an IRR at that point of 15.1% annually for a very profitable stock which has no debt on the balance sheet and is consistently buying back shares. I think 15.1% for a company is stable, as Texas Instruments is a very attractive yield, and I'd definitely be interested in buying Texas Instruments at this range simply because of the safety that it provides to my portfolio. But if the price goes up a little bit, let's say to about the $200 range, I expect an IRR of about 8.6%, which is definitely underperforming the market, so I think at that point I would not be interested. So this was Texas Instruments. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!